Generally speaking, real estate investment trusts are well positioned to keep growing their dividend payments in 2024. That's because the payout ratios of most REITs are historically low, their balance sheets also the strongest they've ever been, rents keep growing in most property sectors, and since REITs retain a lot of cash flow, they're also able to keep on acquiring more properties, and then finally interest rates are expected to be cut later this year, which would also benefit REITs. This explains why so many REITs have already hiked their dividends in the first months of 2024, and I expect many more dividend hikes in the coming quarters. But unfortunately, not all REITs are doing this well. This is a vast and versatile sector, and there's a minority of them that are really struggling and are at high risk of cutting their dividend later this year. Hey everyone, this is Jussi. I run a small investment firm that specializes in REIT investing. In today's video, I'm going to talk to you about 3 REITs that I expect to cut their dividend in 2024. But before I get into it, could you please do me a huge favor and click the like button? That will really help me a lot to grow this channel. Thank you so much in advance. So the first REIT that I expect to cut its dividend is called Global Net Lease. Its ticker symbol is GNL. This is a net lease REIT just like Realty Income, but the difference is that its dividend yield is about 3 times higher. Today its dividend yield is about 16%. It's fully covered by its cash flow, and most of its revenue is coming from investment grade rated tenants. This has made it very popular among high yield seeking individual investors, but there are 3 reasons why I think that this dividend is not sustainable. The first thing you should note here is that the dividend coverage is very tight. Their payout ratio in the third quarter was about 90%. They haven't released their fourth quarter results yet, but in any case, there is very little room for error here. Secondly, the REIT has a lot of leverage. Its debt to EBITDA ratio is about 7.7 times. Its LTV is nearly 60%. That's far more than its net lease peers like AgRealty, NAREIT, or Realty Income. This means that it's going to face severe headwinds from rising interest expense in the coming years, and the REIT has itself already announced that it's planning to divest some of its non-core assets to pay off debt and reduce leverage. This will be dilutive to its cash flow on a per share basis and cause its dividend coverage to become even tighter than it already is. Then thirdly, the REIT today generates about 20% of its revenue from single-tenant office buildings, and I suspect that many of these assets today have an equity value of 0 or even negative. According to CBRE, office property values have dropped by about 40% on average in recent years, and we know that single-tenant office buildings are struggling more than the average. Since Global Net Lease has an LTV of about 60%, this means that a 40% drop in its office property values would cause its equity to be wiped out. This large drop in property values explains why another net lease REIT called WP Carey recently decided to exit the single-tenant office property segment. It did so in a rush by spinning off most of its properties into a separate REIT. This then forced WP Carey to cut its dividend, despite having a lower exposure to this sector than Global Net Lease and having a stronger balance sheet. And if WP Carey couldn't escape cutting its dividend, I think it's very unlikely that Global Net Lease will be able to sustain its own. And as a reminder, the share price of WP Carey dropped by roughly 20% in the weeks following its announcement that it would cut its dividend, and so knowing this, I wouldn't want to own shares of Global Net Lease today. A final thing that I want to add here about Global Net Lease is that historically the management has done a really poor job. It has regularly issued a lot of new shares into the market at very dilutive prices, and this has caused its FFO per share to decline over time, and its track record is just one of the worst in the entire REIT sector, having delivered very poor total returns and having also cut its dividend already in the past a few times. Before I go into the second REIT, please let me know in the comment section below what REITs you're buying at the moment and why. I'll respond to you and share my thoughts on if I think that those REITs are attractive today. Then the second REIT I expect to cut its dividend later this year is called AGNC Investment Corp. This is a mortgage REIT that's currently offering a roughly 15% dividend yield. But the issue here is that just like other mortgage REITs, AGNC is very heavily leveraged, and its entire business model is dependent on unpredictable macro factors like interest rates and spreads. Just recently, the company held its fourth quarter conference call, and an analyst asked about the dividend sustainability, and the response of the management was quite interesting to me because it was very long, and that's a big red flag to me. Here's the section of the Q&A that I'm referring to. The analyst asked, wondering if you could talk about your outlook for the dividend, kind of given the volatility we just managed through, and kind of how you're thinking about the dividend levels throughout 2024. And so here's what the management answered. Sure, obviously a lot goes into the dividend decision, always does, in terms of the operating environment, our expectation about leverage on a going forward basis, and importantly, interest rate volatility and sort of cost of rebalancing. But again, like I mentioned last time, another key input into that equation is what is our break-even ROI, which stands for return on equity, on our business when you take into account the dividends on both our common, our preferred equity, our operating costs, and what is that number on a percentage basis of our total capital. That number, for example, at the end of the fourth quarter, if you analyze those numbers, is somewhere as a break-even return on equity of around 15.5%. And then he kept on going with a really long answer. And in my opinion, this essentially tells you that the dividend is not sustainable, it's not set in stone. And because if the dividend was sustainable, the management could have given you a very simple and straightforward answer, and they didn't in this case. And to be clear, it's not just AGNC. There are many other mortgage REITs that I think are at high risk of cutting their common dividend later this year. Another one is Arbor Realty Trust. I haven't discussed it previously on this channel. I actually like its preferred equity, but I think that the common equity is too risky and the dividend cut is very likely here. KKR Real Estate Finance is another mortgage REIT that also recently cut its dividend, and I think that there will be many more dividend cuts in the mortgage REIT sector. Then the third REIT that I think is at high risk of cutting its dividend is called Omega Healthcare Investors. Its ticker symbol is OHI. Omega is the leader in the skilled nursing segment of the property market, and it's been dealing with a very tight dividend coverage already now for a few years, but it has refused to cut its dividend because it does not want to ruin its long track record of steady dividend growth. But just recently, ahead of its fourth quarter, the REIT announced that its dividend once again won't be covered in the fourth quarter, and this is because it's struggling to collect rent from some of its tenants. In late 2023, 2 of its tenants didn't pay their rent in full, and more than likely their struggles will continue in the coming quarters. And as a result, the dividend currently isn't fully covered, and I think that this is a particularly big issue for Omega because it's also going to see its interest expense rise in the coming years. Therefore, I think that Omega's dividend is very risky. I wouldn't buy it expecting to earn steady dividend income. I think it can still be a good total return investment over time because its valuation is relatively low. The management has a really good track record, the balance sheet is in good shape, but just don't buy it for the dividend. So the whole point of this video was to highlight to you how important it is to be selective when investing in REITs. This is a very vast sector and not all REITs are going to be able to sustain their dividend in the coming years, and a dividend cut could lead to significant downside. Now, if you want to access my entire real money REIT portfolio, you can join High Yield Landlord, which is my REIT newsletter, for a 2-week free trial. I'll put a link to it in the description of this video. As I've noted before, this is a real 2-week free trial in the sense that you won't be charged anything in the first 14 days. So if you want to come just to access my portfolio and then sign off before the free trials ends, that's perfectly fine with me. And if you decide to stick around, you also get a discount as part of our New Year sales campaign. And then finally, once more, if you could please click the like button, that really helped me a lot to grow this channel. Thank you so much in advance, and see you at my next one. Bye bye.